Brazil and China have agreed to ditch the dollar. Just this week, Brazil and China agreed that they will no longer have to use the dollar to exchange goods with one another. So what happened before this week is when Brazil or China wanted to trade with each other, what they would do is they would take their currency, whether it's the Brazilian real or the Chinese yuan, they would then take that currency, convert it to dollar, and then convert that dollar to the other country's currency to buy whatever goods they wanted. This week, Brazil and China agreed that they're no longer going to do that, that they're going to transact with their own currencies and no longer use the dollar. This is good news for Brazil and China because that means that it's a more efficient transaction. They can avoid fees and it's more power for their currencies. But it's not so good for the United States because it shows that you're seeing less and less powerful countries around the world that want to rely on and use the dollar. We've already been seeing, and I've talked about this multiple times, BRICS nations, which are Brazil, Russia, India, China, and South Africa, who have been coming together to want to create a new reserve currency because they don't want to keep relying on the dollar. They don't want to have to be bullied by the United States, which is the world's superpower. The United States has the world's reserve currency. Well, the BRICS nations have been working already to kind of move away from the dollar. And now we have Brazil and China, which just struck a deal this week, which said that they no longer want to transact with the dollar, that they want to transact with their own currencies. Now, you might be wondering, why is that a big deal? Who cares what Brazil and China are doing because that doesn't really affect us? Well, it does indirectly affect us because it shows the value of the dollar relative to other countries. Because see, our dollar here, the United States dollar, is the world's reserve currency. Countries around the world save their money in dollars because dollars are looked at as the safe haven. And so when you have countries around the world and the biggest governments around the world that have faith in and trust and believe in the United States dollar, it makes the dollar more valuable because our US dollar is not backed by physical gold or silver or other metals. It's backed by a promise. It's backed by the full faith and credit of the United States government. So as long as people believe that our paper dollars have value, then they will have value. And what we're starting to see happen is the BRICS nations, and now especially Brazil and China, are working to move away from the dollar. And we also have many countries around the world, notably China and Japan, which are big investors and owners of the US dollar. They have lent a lot of money to the United States. They own a lot of dollars. And so this is a concern because if countries are worried about the health of the dollar, they're worried about high inflation, then it makes them less interested in wanting to own or invest in the dollar. This is why understanding the impact of inflation on our dollar and the health of the world's reserve currency is so important because yes, we have high inflation right now. And I'm going to talk about the new PCE, Personal Consumption Expenditure Inflation Report that came out today in just a second. We still have high inflation. And when you have high inflation, the first part of that is it makes it more expensive for regular people, consumers, to buy things because now when you go to the store to buy your stuff, it costs you more money. But then the second concern is you have people, investment institutions, and countries that are concerned about their investments in the dollar. Because when you have very high inflation, that means that the value of your investment, your dollar, is dropping. And you don't want to see the value of your dollar dropping that fast, especially when it's supposed to be the safe haven for your money. That's why this new agreement between Brazil and Russia is so important to understand. We did a full deep dive of this in Market Briefs. If you haven't joined Market Briefs yet, this is why you should, because it is a easy and free way for you to stay up to date on what's happening in the financial news when it's happening. That way you can be a more informed and educated investor. It's a free newsletter that my team is writing where we break down what's happening in things like the global economy, our own economy, inflation, the housing market, stocks, crypto. So it's super fun and easy to read. You can read it in less than 5 minutes every morning and it's completely free. So if you want to join Market Briefs, I got that link for you down in the description below. This is where now I want to slightly shift gears and talk about the new inflation report because earlier today we got the new Personal Consumption Expenditures Report, the index, PCE. This is also known as the core inflation number, and this is what the Federal Reserve Bank likes to look at. And the difference between this inflation number, PCE, versus, say, CPI, which is the headline inflation number, this is the inflation number that everybody talks about in the news, is that this core inflation number looks at the CPI and then it takes out what they call the volatile numbers, which are energy and food. So this is the number that the Federal Reserve Bank likes to look at, even though we all know how important energy and food prices are, but this is what the Federal Reserve Bank likes to look at. And what it shows us is that in the month of February, PCE rose by 0.3% month over month, which is lower than what was expected. It was expected to rise by 0.4%. Now, that doesn't mean that the prices of things have fallen. That just means that the prices of things rose less quickly than what was expected. So what does this mean? Well, you have a lot of opinions that come out on this, and this is where, I'm going to emphasize this one more time. There's a difference between data and analysis. My goal for you is not to tell you what to believe. I want you to understand the data. That way you can make your own opinions, because most traditional media is in the business of selling hype, and they're going to make their own analysis, which may or may not be true. And what I'd rather you do is understand the information and then create your own analysis. So understand the data, look at the raw numbers, and then come up with your own analysis. That way you can make your own investment decisions that are more educated rather than making emotional decisions, which is why so many people end up losing money when they invest. So PCE came in and it said that it increased by 0.3% more month over month, which is slightly lower than expected, but it's still extremely high. And so now the reason why this is important is because now the Federal Reserve Bank is going to look at this inflation data, they're going to look at next month's inflation data, and then they're going to want to decide what to do with interest rates again. In the most recent meeting, what Jerome Powell said was that essentially the banking crisis that we're seeing here in the United States is good news for the fight on inflation. And the reason why is because inflation means that you have an increase of money out there. That's what inflation is. You're inflating the monetary supply. But the question is, what is money? Money can be the money you work to earn. You go to work, you earn $100, but it can also be credit, loans, debt. Because now when you have an income and you have this $100, banks are going to look at you and say, oh, you're creditworthy. Let's loan you an additional $100. So now your spending power goes from $100 to $200, which increases buying power, which increases potential inflation, because inflation, then when you have more dollars floating around and people have more buying power, they can buy more things. When you have more demand to buy things, like if there's people that want to buy homes, lots of people want to buy homes, that pushes the price of homes up when you have more demand than supply. And so what the Federal Reserve Bank was saying is that we have been actively working to bring down inflation by raising interest rates. When we raise interest rates, it makes things less affordable, which reduces demand. We haven't seen much success with that. Yes, inflation has come down off of its peak, but it's closer to the peak than it is the target goal, which is 2%. And then they went on to say that the banking crisis that we're seeing is going to create a bit of a credit crunch, meaning less available credit, less loans, less money from banks floating around, which he says will help assist on the fight on inflation. What does that mean? Well, that means that, again, two types of money. You have money and then you have debt, credit. And so the money is still there, but the credit levels are going to go down because of the credit crisis, because of what we're seeing in the banking market, in the banking sector. So banking sector is getting hurt, which means less loans, which will help reduce demand, which should help cool down inflation. This is what the Federal Reserve Bank is saying. Now, how likely is that to happen? Well, this is where, again, you want to pay attention to the data. This PCE number that we got is from February. What we've been seeing more recently in March is that with interest rates kind of stabilizing where they are right now, a little bit under 7% for mortgage rates, with interest rates where they are right now, people are starting to spend again. I was recently talking to some realtors and mortgage people here in Manhattan, which is where I am right now. And people have been saying that the early part of this year, January and first half of February, was very slow. And it was looking very slim and not good for the entire real estate market. In the later part of February and March, it picked up again. Mortgage rates went down a little bit and people have been buying homes again, which has been boosting demand, which could cause a reverse in home prices, because we've started to see home prices come down slightly. And so we might see, and again, this is just based off of what I've heard, we'll see what actually happens. But it could mean that we could see prices of things start to rise if demand continues to rise. So let's see what actually happens, but you want to keep an eye on demand. How much are people spending? How are they spending? Because in the most recent reports, we've been seeing that people have been going deeper into credit card debt, digging into their savings to spend money. And the availability of credit. This is a new factor that we really want to keep an eye on, because now with what's happening in the banking sector, obviously there's a lot of concerns about banking. If the availability of credit and loans decrease, that could have an impact on inflation and a big impact on the economy as well. So keep an eye on the Fed, keep an eye on what's happening in the economy, keep an eye on what's happening with credit availability. We'll be keeping you posted on all of this on Market Briefs, my free newsletter, which is why if you haven't joined that, make sure you do so. But this is where, again, the financial education is important. That way you don't blindly listen to anybody. You don't blindly listen to a random guy on YouTube. You don't blindly listen to headlines. You read the data and make your own analysis instead of just listening to what other people are saying.